to this workshop, Tax Planning Essentials, the basics of our national tax system. I am Janelle Cross. In this workshop, we will cover the basics of our nation's tax system, the different types of income, tax deductions and credits, and we'll review some types of tax management strategies. We pay a variety of taxes, with the most significant being federal income tax. Most of us also pay state and local taxes. In some places like Philadelphia, there's an additional city wage tax. It's important to know what types of taxes you pay based on your situation. Also, different types of income are taxed at different rates. We'll cover that in more detail shortly. Finally, the primary way to reduce your tax bill is to take advantage of credits and deductions. The list of credits and deductions and the corresponding taxpayer eligibility changes regularly. For this reason, we recommend you work with a tax professional or use professional software to file your return. I mentioned that most of us will pay state taxes. There are some states that do not have an income tax. The absence of a state income tax is often a reason folks move to these states in their golden years. In addition to these states, New Hampshire and Tennessee do not apply a state tax to earned income, but they do tax some other forms of investment income. Let's begin learning how to manage your tax situation. First, calculate your ordinary income. Ordinary income includes various streams of income from employment, wages, to rental and unemployment income. One note regarding Social Security income. For some folks, Social Security income is not taxed at all. For others, 50 to 85% of the benefit amount is taxed. The amount of tax paid on Social Security benefits depends on your total household income. This is why tax planning is just as important in retirement as it is during your working years. It's also a benefit of Roth savings, which are tax-free in retirement if you've had the account for at least 5 years. Ordinary income is subject to ordinary income tax rates, which we'll take a closer look at in a moment. Unlike ordinary income, there are some forms of income that receive more favorable tax treatment, including specific types of investment dividends deemed as qualified. This is reported automatically on your tax document. If your investment dividends are qualified, you pay tax at the lower capital gains tax rate. Because qualified dividends are not the most common form of dividend payment, be sure to check with a tax advisor regarding your situation. Also, long-term investment gains are taxed at the lower capital gains rates. To qualify, you must own the investment for more than 1 year. I want to emphasize that the length of time you own an investment matters a lot when it comes to paying taxes on investment earnings. If you buy an investment at a low price and sell it later at a higher price, you've generated a capital gain. Great job! But while you are celebrating your investor prowess, don't forget that you need to pay tax on that gain. If you've held the investment for less than 1 year, the gain is taxed at the higher ordinary income tax rates. But if you hold the investment for more than 1 year before selling, your gain qualifies for the lower capital gains tax rate. This is important to consider if you're thinking of selling an investment you purchased recently. Investing should be a long-term exercise, and we discourage investors from buying and selling quickly. Saving money on taxes is a good incentive to do that. Let's look at the difference between federal income tax rates that apply to ordinary income and the lower capital gains tax rates that apply to qualified dividends and long-term capital gains. The maximum income tax rate is 37% for the highest earners, but the highest capital gains tax rate is 20%. Note that many taxpayers will qualify for the 0% tax rate on capital gains, which means gains generated by selling profitable investments may not be subject to any tax at all. Especially when market returns have been strong, it's worth cashing in some of your winnings, especially if there is no tax consequence for doing so. An important concept to understand is the difference between your marginal tax rate and your effective tax rate. Consider a married couple filing a joint return earning $115,000 per year. what would their tax rate be? If you looked at this table, you might guess 22%, and that is correct as it relates to their marginal tax rate. Our tax system is a progressive tax system. In other words, regardless of how much we earn, every married couple pays 10% tax on the first portion of taxable income, 12% tax on the next, 22% on the next, and so on. Let's look at an example. Our married couple earns $115,000 per year. In this example, we assume they take the standard deduction, which excuses this amount of income from any taxation at all. Their earned income minus the standard deduction amount gives us their taxable income, which passes through the tax table. After all is said and done, they pay a total of $9,793 on their $115,000 income for an effective or actual tax rate of 8.45%. That's a lot different from the 22% marginal tax rate we started with. I count myself among those who dislike paying taxes, but I've also seen folks spend a lot of time fiddling with tax strategies without truly understanding how much tax they're actually paying. That brings us to step number 3, knowing your deductions and credits. These terms are easily confused, but their impact on our tax bill is very different. Consider an $800 deduction versus an $800 credit. If your taxable income is $50,000, that $800 deduction would reduce your taxable income to $49,200, on which you pay approximately 15% in taxes for a total tax bill of $7,380. The deduction reduces your tax bill by $120. On the other hand, a credit reduces your tax bill dollar for dollar. So an $800 tax credit saves you a full $800 in taxes, reducing your tax bill from $7,500 to $6,700. You can see that the credits are more valuable than deductions. A primary focus of tax management is making sure you're getting as many credits and deductions as you can. Snagging deductions and credits used to be a more common taxpayer activity, but the 2017 Tax Cut and Jobs Act nearly doubled the standard deduction. In 2025, the standard deduction is $30,000 for married taxpayers and $15,000 for single taxpayers. But what is the standard deduction and how does it impact your tax situation? Well, there are expenses that qualify as itemized deductions and can be claimed to reduce your taxable income. Examples of expenses eligible for itemized deductions include medical expenses, taxes, mortgage and investment expenses, charitable contributions, and others. If you work with a tax professional or use tax software, you might be accustomed to providing amounts you spend in these categories. But just because you provide the information doesn't mean it's actually used in calculating your tax bill. You get to use either the total of your itemized deductions or the standard deduction, whichever is greater, but you cannot, unfortunately, use both. Here are some things to know about some specific deductions. Medical expenses can only be itemized if they exceed 7.5% of your adjusted gross income. If you have any elective expenses, you might attempt to group them into the same tax year if you think you could exceed that 7.5% limit. State and local taxes can only be itemized up to a certain amount. So states with high state taxes like Maryland, District of Columbia, and Massachusetts may pay more in taxes than they can itemize. If you own an expensive home, only a portion of your mortgage debt interest can be itemized. Finally, charitable contributions, including monetary donations, non-cash items like clothing and furniture, or even appreciated investments can be itemized. These are the most common since many of the miscellaneous itemized deductions were eliminated in 2017. Remember I said you get to claim the higher of your itemized deductions or the standard deduction? For most folks, the standard deduction will be higher. Let's walk through 2 examples to make sure this makes sense. Take a married couple with itemized deductions that total $22,500. Since that is less than the standard deduction, they will claim the standard deduction on their tax return. So although you enter all those itemized deductions, it doesn't mean you actually use them. Here's a different example of a single taxpayer who has itemized deductions of $16,500, which exceeds the standard deduction. This means the taxpayer will claim their itemized deductions instead of the standard amount. Let's discuss some common tax credits. Now remember, tax credits have a more significant impact on lowering your tax bill. First, if you have children, you may qualify for the child tax credit. Now, this credit is based on household income and is phased out as your income increases. There are other family tax credits for households with children, including family tax credit, child dependent care credit, and the adoption tax credit, most of which are also income dependent. The Lifetime Learning Credit and American Opportunity Credit are available for qualified education expenses for yourself or a dependent. Similarly, there is a deduction, albeit not a credit, available to folks making student loan payment. The deduction is income-based and limited to a specific amount. And this brings us to step number 4, tax planning strategies. One of the best things you can do is to be sure you understand the general workings of our tax system. Consider working with a tax professional to be sure you're catching all of your deductions and credits. Contribute as much as you can to your 401k, and if you have one, your HSA account. If you're making traditional pre-tax 401k contributions, the amount you save reduces your taxable income. HSA contributions are also deducted from your taxable income. If you're saving for future college expenses for a child or grandchild, doing so inside of a 529 college savings account might reduce your state tax bill. To find out what's available in your state, check out the state tax calculator on the website savingforcollege.com. And whenever possible, try to bundle expenses in the same tax year if you're close to exceeding the standard deduction amount with itemized expenses. For example, you might make 2 years of charitable contributions in the same tax year, or you might postpone elective medical expenses to the same tax year. And finally, if you invest outside of your 401k and IRA accounts, talk to your financial advisor about tax loss harvesting. This is an exercise where you sell investments that have lost value in order to offset capital gains created by other investments. Also, talk to your tax professional about some of the above-the-line deductions that may be available to identify any that apply to you and your situation. This is a lot of ground to cover, but I hope it was a good basic introduction to our nation's tax system. Now, don't try to tackle everything all at once. Rather, just focus on taking the best next step. And remember, Align is here to help, so just reach out. Thanks for spending some time with me today. We look forward to connecting with you.